This is the second video, technical video, that goes along with Chapter 1, Part 1 of the M&A modeling series. And I have a little picture of the exchange rate. And we're going to use an exchange of shares. I want to emphasize that an exchange of shares is kind of like an exchange rate, and we're essentially using the two currencies. In the lecture that I've done, I haven't really done this. I'm actually doing the technical stuff first, but whatever, you don't care about that. We have one company, in this case Lincoln National. They're the target because they have a relatively low PE. The acquiring company has a higher PE, and we're using the currency of the higher company, the stock price, when we're exchanging shares. It's like you go and exchange euros for USD, okay? And I'm also, this time, I'm going to use this file that I gotta admit, not necessarily proud of, but I worked hard on it, really hard, okay? And I have this file that I better find. Now, I am in the, when I produce these videos, I guess I am the producer. I'm going to show you where I find all of this stuff. Okay. And now this is, I'm struggling a tiny bit with what to name this. This is our file. Now I'm going to, throughout this class, use this file more than anything else. This is the one that really has multiples, and where we get all the historic data, combine it with the stock price data, combine it with the analyst forecasts. And we're going to use this, and we're going to make a little analysis of what happens. Apple is the target company. They've got a relatively low PE. Google is the acquiring company. They've got a relatively high PE. We're going to put these two companies together. We're going to have a premium paid by Google, because they're the acquiring company. And then we're going to have the estimate from the market of Apple, and then Google, because Google's going to say, I'm going to buy you. Shut you're going to have to use all my software. So we're going to figure out what the earnings are for Apple. Just multiply the shares by the earnings per share. Do the same thing for Google. I should have put it in. And then we're going to see what the total earnings are. And then after we get the earnings, we're going to look at combined EPS after the merger. And we're going to look at standalone EPS for Google. Now, the first time I saw this, sometime in the 1980s, I was so impressed with these investment bankers who could just, they were showing what the accretion and dilution and the chief financial officer or the vice chairman, excellent actually. Oh, that's so cool, that's so cool. We're going to show you, and this is, I am sorry, this is Google. Google buys Apple. I could say that, I purposely retyped this, but I'd kind of be lying. Okay. Perhaps this is not structured. I hope you see where we're going now. Let's get some of the data, and here is the big idea, the big theory behind this is, even if we don't put any synergies in the last thing we said, everything is about economics. Everything is about paying the premium and getting more synergies than the premium. This time we're going to put no synergies in, and we're going to see what happens to the earnings per share on a combined and standalone basis, and we're going to do a little bit of graphing and a little bit of a little bit of this business of putting our little gimmicks in. I don't know, spinner buttons, okay? And when you do this, I'm going to say, well, let's put a 0% premium up to I don't know, a 70% premium. And we've got to go back and forth. I've talked about this so many times that I really don't want to repeat myself too much, because some investment banker guy yelled at me about repeating myself too much, so I feel all bad. Okay, all right. I'm all losing my confidence a little bit on this stuff. So let's put. I'm making it. Ooh, no, I shouldn't have done that. Just a minute. I'm going to leave the calculation manual. The reason I'm doing that is because we have this wonderful other file. And in this wonderful other file, okay, that last thing wasn't such a bad thing. Okay, we have. I'm going to show you. We're going to talk about all these multiples, and we can look at PE multiples, and I guess if we take a peek at it right now, we have, let's look at a forward PE. A forward PE is much better to look at because a forward PE is, and I have to fix the formatting here. Oh no. I had another video on this actually, so I'm not going to do it. Oh, there's a conditional formatting. Sorry about that. This, just let me pause for 1 second. Okay, I just changed the conditional formatting. If you want to know how to kind of do the conditional formatting, sorry to repeat this. You just select the whole area. You start at the top left up here, and then you make a rule, and the rule can be kind of tricky. In this case, I said the absolute value of the first one. If it's less than 1, use a percentage. If it's more than 1, use a number, okay? So the PE ratio for Google, and if we look kind of at the end of 2017, it was 22, 23. Forward PE is much better to look at. If I look at Apple's PE ratio, 14, 14, 10, 10, 11, 11, 13. So you see these kind of increases in the last year compared to some of the history, although I guess it was higher here. And you can kind of look at a lot of these other companies and see, let's look at Walmart. You can kind of see how their PE ratio has gone up, and that's the real question. Are these PE ratios, why are they higher? And then you can look at all these things with really the EV to EBITDA, but in this case I have EBITDA growth. Below the EBITDA growth, we have the enterprise value, and all the way down here we have the cost of goods sold to revenues, the R&D to gross margin, the cash and investments, and you can get all of this stuff. And I've talked about this too much. All you do is go and click on the ticker symbols. You've got to wait a little while, and then you get it. So here was Google's. Let's look at Google's forward PE. Okay. And here is what it is now. And then I also put, they don't have to pay any dividends. Okay. Oops. And then I put their ROE that's expected, their next year, current year kind of estimate of what the earnings are. We kind of have the historic numbers here. I guess this is, no, this is next year and then the year after. And then I think that's enough. And then they make a forecast of the growth rate. They expect the analyst a 20% growth rate. You can kind of look at what the Market Watch has here. It's got the same sort of earnings growth. They also publish revenue growth. So I tried to put everything together. I'm very proud of this, obviously. And you can see what's happened to the EV to EBITDA ratio. Oh, this is EV to invested capital, which is like price to book. Let's put EV to EBITDA, and you can get this. And let's So let's copy this and let's just, oops, there's my Exchange thing, and let's copy this, and I'm just gonna paste it into our little thing here, okay, and there's our acquiring company, okay. Oops, I should have moved it there, shouldn't I have? Okay, and now I'm going to do the same sort of thing with Apple. Now I'm doing this purposely. So that you can see how easy it is. So you could just cycle, if I want Facebook, if I want Amazon. I'm obviously experimenting with some of these companies that, who knows, Home Depot, Walmart, you know, these kind of big companies. And we're going to focus on Apple, and then you can get all of the other things and just kind of cycle through them with these little spinner boxes. And that's exactly, by the way, what we're going to do here. So I don't care. I wanted their forward PE. Okay. And so let's do the same thing. We're going to then make we have, with this little page, we have enough to do our accretion and dilution, and do it in a relatively sophisticated way. And I'm not going to be like all these fancy books, these cash flow books that say, this is the worst thing you could ever do. Okay, you have to think about it, because realistically, people do this kind of stuff. Okay, you don't have to do anything, but I think if you think about kind of why the PE is higher and what's really going on, and try to demonstrate it. So we have over here, let's start filling in Apple's price per share. Is, and this, I took this, the market, this went crazy. This is one of these 1,000-point drops in the Dow today. So this is right after that. Apple was, I didn't take my pills to make my brain work today. So Apple's stock price was 171.21. Okay. And plop that in. And then we go and say, well, Google's stock price was over there 1005. Much higher stock price. Doesn't mean anything really. We have to shift control 1 perhaps. And then Google had, let's find out how many shares they had. And I put the shares here somewhere. They had 349,480. I found a little problem with that one. 349,480. And Apple had, I hope that's okay, Apple had down here 5070. Okay. So we could kind of get the market value. Why don't I do this? Okay. There. How many trillions of USD is this or something? Okay. All right. Okay. Okay, so Apple has a higher market value than Google. Now, we can then put the estimate and what we're going to do. Okay, before we do this, let's see. So Google has, Google's going to go buy all these shares of Apple, and they're going to pay a premium. Okay? And what I'm going to do right now, by the way, is I am going to close this file. Okay. And I don't really have to save it, do I? And now I can put my calculation option to automatic accept manual, and we can kind of push this up, and we're going to make a little graph out of all this. So Apple's share price, their next year's estimate was 11.5 and then 13. So let's just put their earnings per share, 11 first and 13. Okay? There was, excuse me. And I did it wrong. 11.43, 12.11. 11.43, 12.11. And then we said, they told me Apple is going to grow. Perhaps this isn't exactly right, but Apple is going to grow by 11.16%. So let's just put some growth rate in here. Okay, so we can put 11.16% here as a kind of transparency principle, and then copy that across. So that's Apple. Now Google, they are going to grow by 20.37%. So we kind of started to see the issue. And then Google is going to have earnings of 41.48 first. And then in the next year, they're going to have earnings of 48.42. Okay? And this you get all, so part of this is really, oh my gosh, you can get this kind of stuff. It's, for me, it's hard to fathom, really. Okay? So that's enough. Now, if we pay a 15% premium, here is the target company, Apple, the target share price divided by that's the current exchange rate. If I went to that booth and said, I want to exchange my Apple shares for Google shares, right now, I would only get 0.17 Google shares for every Apple share. And then if I go and say, no, you're going to pay, it's like we pay more euros for the dollars or whatever, I'm going to then get 20 as my exchange rate. So I'm going to get more for my Apple, and then I can put in, I say when I'm a little nervous, then you can put in and get these different exchange rates. Now I'm going to leave the synergies out. So let's put the shares here first. So let's put the shares of Apple, and then we can take the Apple and multiply this by, I'll put the F4 3 times, and then that's the earnings we get from Apple after we consolidate this. And then we can take the shares of Google, and then we can take the earnings per share and multiply that again. Okay? Oops. Did I do something wrong? No. Okay, I need to make it a little wider. Excuse me. Okay, and I have a little shortcut to do this. This is what's freaking me out a little. Okay, so Apple actually gives more. And then if I want the total without synergies, I can select this across and press Alt equal. That gives me the total. And I can press Shift Control R a couple times, Shift Control E to get the underlines. And then I'm going to put let's put no synergies in here. Now, if I wanted to make the synergies a little bit using one of these gimmick things, I'd copy this and paste it. And then I would see, well, this says F9 here, so instead of F9, this is 12. Okay, and then I'm going to allow this to go from, I don't know, let's go from 0 to 300 and maybe go by 10. We'll have to kind of see how that all works. And then we'll just take this one and multiply it by 1,000 or something. Or, maybe another 1,000. So, that's too. Okay, so well, I'll leave that. So we can put a little less. Let's put 0 synergies at first. So we get our synergies from this number. And I'm just going to copy those across. And of course, we could put all this other stuff. So our total, including the synergies, I can just select this one, alternate equal, and then get it to copy, Shift Control R if you want. And now we'll put our year in. And once we put our year in, okay, now we're just about getting there. Now the total amount of shares that we have after the merger would be the total amount of Google shares plus the total amount of Apple shares times this exchange ratio. Okay, so we have to issue, it's like issuing a whole bunch of more equity. So we get this total earnings. All I did is add the earnings up, and I divide that by the number of shares, and whoa, we get a accretion, but that accretion goes away at the very last year. So this is kind of this, I suppose you could say it's almost like a short-term thing where you get a kick in your earnings per share, but that might not last so long. And I'm gonna, what I'm gonna have to do is move this total number of shares. I'll put the total number of shares here, because if I want a graph of this, now Shift Control 1, then I would delete the year, select this area, and I'm going to just press F11 to make a graph. And then I have the standalone and combined earnings per share, and better yet, okay, let's make the thing a little bigger. Okay, so part of this is really, the rest of this video is just going to make a presentation and put the synergies and premiums. So right now we have accretion in earnings per share, but it turns around because of this different growth rate estimate, and that's the problem kind of with Apple. Can they continue to grow if they're just making iPhones and not making new self-driving cars or whatever? Okay, and then we can put the premium here, and we put I'm just copying this, of course, and then we put the synergies and over here, and that's going to be the title for our graph. And how about this? I put the synergies in. Let's just put some synergies in. Okay, so that's whatever, they're probably billions or something. And then we can, so if we get this many synergies, we can see what happens. Now, then we get a accretion if we have the synergies. Okay, and this is, again, kind of showing you how to compute break-even synergies in this accretion and dilution example. So we click on these, and then perhaps let's make the title a little bit bigger so we can really see what's going on. Okay, and then the final idea of this one was just simply to show you, okay, well, let's take this little gimmick we have over here and put it next to our graph. So let's put the kind of thing here, and then let's take the synergies, synergies and copy those and put those right underneath. This one, it always goes over here, and then we can kind of see, okay, what's happening to our earnings per share with and without the merger. Okay, and enough of the kind of switching the graphs around. I hope I'm not irritating you. Okay, and I forgot, what did I put about this one? Okay, and we can see, well, all right, if we pay a higher premium, then we lose our accretion in earnings per share, especially by the end. But if we put more synergies in there, we can see how much synergies do I need to just get this kind of accretion and dilution to work at the very, very end. So this is the acquisition modeling exercise file. There's one that's complete and non-complete. This is the complete one. And that's the end of the video.